Hey investors, welcome to my channel, where we turn complex financial reports into actionable insights. In this video, I will walk you through companies' key business metrics, analyze their growth trajectory, and break down their financial performance in simple, clear terms. So let's get started. HCL Tech is a technology company that provides digital transformation solutions, integrating technology and people. The company operates in over 60 countries, with over 200 delivery centers and over 150 innovation labs. The workforce employs approximately 227,000 employees. In the past 3 months, there has been a decrease of 6.35% in the stock value. HCL Tech has a global presence, serving global enterprises with a diverse team. HCL Tech operates through 6 primary segments. These are engineering and research and development services, IT and business services, digital business services, digital foundation services, digital process operations, and HCL software. Engineering and research and development services focuses on helping clients improve their profits and create new ways to make money by improving their products and platforms. This includes product and platform improvements and network engineering. IT and business services provides digital solutions in areas like applications, artificial intelligence, infrastructure, cloud computing, and digital operations to support companies globally. Key services include cloud upgrades, cybersecurity, and modernizing digital workspaces. Digital business services transforms how companies work, improving user experiences, enabling adaptable platforms, and using data to create value. This involves digital consulting, custom applications, and commercial application services. Digital Foundation Services provides infrastructure and digital solutions driven by AI and automation, ensuring reliable and secure operations. Key services here include hybrid and multi-cloud services, digital workplace services, and cybersecurity services. Digital Process Operations delivers updated operating models, using expertise, engineering, and AI to improve customer experiences. Services include digital workforce solutions, redesigning digital processes, and providing enterprise functions as a service. HCL Software offers software products and cloud solutions across different areas to help organizations improve their competitiveness and insights. This includes total experience solutions, data and analytics, and intelligent operations solutions. Now, let's look at the shareholder returns of this company. Over the past year, the company delivered an impressive return of 26.02%, outperforming the industry average of 11.4% and the broader market at 8.83%. This highlights its strong performance and ability to generate exceptional value for investors. Let's examine the company's steady revenue growth. Revenue grew by 3.56%. Looking at the quarterly trend from Q3 2023 to Q3 2024, revenue increased from 284 billion to 299 billion INR, showing a fluctuating but overall positive trend. Revenue is simply the total money a company brings in before any expenses. Think of it as all the money in a store's cash register at the end of the day. The company shows strong cost management capabilities. Gross margin stands at 42.39%. Since Q3 2023, this number has shown an overall upward trend, fluctuating from 43.01% to a low of 37.33% in Q4 2023, before recovering. Gross margin is what's left after paying to create your product. If you sell something for $100 and it costs $70 to make, your gross margin is 30%. Higher is better, showing efficient production and strong pricing power. Operational efficiency shows notable improvement. Operating margin is at 19.47%. The trend from Q3 2023 to Q3 2024 shows a fluctuating pattern with an overall stable trend, moving from 19.84% down to 17.09% in Q1 2024, before climbing back up. Think of operating margin as your business's efficiency score. It shows how much profit you keep after paying for day-to-day operations. If you have $100 in sales and spend $70 on everything from production to salaries to rent, your operating margin is 30%. Profitability shows positive momentum. Net margin is 15.36%. Over the past 5 quarters, we've seen a fluctuating trend with an overall positive direction. Starting at 15.29%, dipping to 13.99% in Q4 2023, then recovering. Net margin is your true profit percentage, the final score of what percentage of sales becomes actual profit. A 15% net margin means you keep $15 from every $100 in sales after absolutely everything is paid for. The company maintains healthy liquidity levels. Current ratio stands at 2.7. Looking at the quarterly trend from Q2 2023 to Q2 2024, we've seen a fluctuating trend, starting at 2.6 in Q2 2023, increasing to 2.6 in Q4 2023, and finally reaching 2.7 in Q2 2024. The current ratio tells us how easily a company can pay its short-term bills. Think of it as having $2 in your checking account for every dollar you need to pay this month. Generally, a ratio above 2 is considered strong, showing the company has ample resources to meet its short-term obligations. The company maintains a conservative debt profile. Debt-to-equity ratio is 0.3. From Q2 2023 to Q2 2024, this ratio has shown a fluctuating trend, starting at 0.3 in Q2 2023, increasing to 0.3 in Q4 2023, and decreasing to 0.3 in Q2 2024. This ratio is like comparing your mortgage to your home equity. A lower ratio means less financial risk. Generally, a ratio below 0.5 is considered comfortable, though this varies by industry. The company demonstrates robust debt servicing capability. Interest coverage ratio is 38 times. The quarterly trend from Q3 2023 to Q3 2024 shows a fluctuating trend, starting at 43 in Q3 2023, decreasing to 32 in Q4 2023, decreasing further to 31 in Q1 2024, increasing to 44 in Q2 2024, and decreasing to 38 in Q3 2024. Think of this as how many times over the company can pay its interest bills, like having $9 available for every dollar of interest payment. A ratio above 5 typically indicates strong financial health. The company delivers solid returns to shareholders. Return on equity stands at 25%. This measures how efficiently the company uses shareholder money. Think of it as the return on investment for company owners. Generally, a return above 15% is considered attractive to investors. The company shows reasonable cash reserves. Cash to total assets ratio is 9.4%. From Q2 2023 to Q2 2024, we've seen a fluctuating trend, starting at 8.6% in Q2 2023, increasing to 9.5% in Q4 2023, and decreasing to 9.4% in Q2 2024. This ratio tells us how much of the company's resources are in readily available cash, like having emergency savings in your bank account. Generally, a ratio above 15% indicates strong liquidity. Now, let us analyze how this company is performing when compared to its peer. The company's price-to-earnings ratio is 27, while their competitors are averaging around 39. In simple terms, you're paying 27 rupees for every 1 rupee of company's earnings, compared to 39 rupees you'd need to pay for the same earnings at their competitors. This lower valuation suggests you might be getting better value for your investment compared to its peers in the market right now, though it's worth investigating why the market has assigned this lower valuation. The company's price-to-sales ratio is 4.06, while their competitors are averaging around 4.49. What does this mean? You're paying 4.06 rupees for every 1 rupee of company's sales revenue, compared to 4.49 rupees for competitors. This lower valuation could indicate better value for investors, as you're paying less for each rupee of the company's sales compared to its peers. The company's enterprise value to EBITDA ratio is 16, compared to the industry average of 21. In simpler terms, this lower ratio suggests the company might be undervalued relative to its peers when we look at its overall business value compared to its operating performance. It could represent an attractive opportunity, though investors should understand why the market values it lower than its competitors. Now, let's break down what analysts are expecting over the next 2 years. According to analysts, the company is expected to show earnings per share of 63 rupees in 2025, growing to 70 rupees in 2026, representing a 9% growth. For context, in Indian markets, A growth company typically shows earnings growth above 15 to 20% annually, while mature companies usually grow between 8 to 12% per year. Looking at revenue estimates, analysts project 9% growth. Generally, growth companies in India should show revenue growth of at least 15 to 20% annually, while mature companies typically grow revenue at 7 to 12% per year. The company's key strategic initiatives involve several areas of focus. One initiative is expanding artificial intelligence capabilities, including generative artificial intelligence, by leveraging partnerships with companies such as IBM, ServiceNow, and SAP. This also includes establishing dedicated artificial intelligence labs to integrate artificial intelligence solutions, ultimately aiming to enable transformation for clients. Another key focus is on artificial intelligence-led transformation and legacy modernization programs, with use cases like legacy modernization, contact center transformation using hyperscaler solutions, and agentic AI for IT operations. Additionally, the company is prioritizing software-defined services with independent go-to-market and research and development investments in the software business for long-term growth in a dedicated products and platforms organization. Strategic partnerships with industry leaders like SAP and ServiceNow are also a priority to drive innovation and operational efficiency for clients. Finally, Project Ascend, a margin improvement plan, remains a key initiative, aiming for efficiency improvements through internal generative artificial intelligence deployments. Capital allocation priorities are directed towards several key areas. First, the company is investing in research and development and go-to-market strategies for the software business independent of services, specifically focusing on software-as-a-service models. Secondly, there is a continued investment in artificial intelligence capabilities by building artificial intelligence labs and partnerships with technology firms like IBM, ServiceNow, and SAP. Additionally, capital is being allocated towards acquisitions, evidenced by the HCL deal to enhance engineering services capabilities and expand its position in the telecom services market. The company is also returning capital to shareholders with an interim dividend of 12 rupees per share and a special dividend of 6 rupees per share, celebrating 25 years of listing, effectively distributing 95.2% of net income as dividends. Finally, the company focuses on improving return on invested capital through profitability improvement and efficient capital management. The execution track record demonstrates several notable achievements. A large transformation program was successfully delivered, though its conclusion in Q3 is expected to impact Q4 revenues, indicating strong project execution. HCL Software achieved an all-time high earnings before interest and taxes margin, indicating improvements in product profitability, which were previously refreshed after initial acquisition. The company saw consistent improvement in days sales outstanding, showing a 2-day improvement quarter-on-quarter and a 9-day improvement year-on-year, reaching the best-ever days sales outstanding performance in recent years. Furthermore, the company achieved a new milestone with the highest-ever earnings before interest and taxes and net income in a quarter, showcasing efficient execution of the company's plans. The employee strength improved in this quarter by a net addition of 2,134 employees, showing successful team leadership. The forward guidance indicates specific expectations for the upcoming period. Revised revenue growth guidance for the full year fiscal year 25 is set at 4.5% to 5% year-on-year in constant currency terms, including approximately 50 basis points from the HCL acquisition services. This guidance is partly affected by the successful delivery of a large transformation program ending in Q3, and the company is relying on discretionary deals to be converted towards the year-end. The maintained earnings before interest and taxes margin guidance is unchanged at 18% to 19% for fiscal year 25, indicating confidence in operational efficiency despite challenges. The company anticipates improvement in information technology spending by companies in 2025, particularly in innovation and efficiency driven by generative artificial intelligence and data initiatives. Finally, the company acknowledges potential significant changes in the global business landscape that could affect client spending priorities, showing awareness of external risks. So, what do you think about this company's future prospects? Would you consider investing in this company? I'd love to hear your thoughts in the comments below. If you found this breakdown helpful, please take a moment to like this and subscribe to the channel. It's completely free, and your support motivates me to create more in-depth analyses every day. Thanks for watching, and I'll see you in the next video where we'll dive deep into another exciting company.